Hello, fellow investors. Welcome back to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, we've got a special episode. I've got my business partner in Hudson Investing, Curtis Edwards, on. He hasn't been on the show in a while. I think it's been a couple of years. We talk a lot on the show, a lot of interviews, right? And we talk a lot about investing in multifamily, but we never really look at specific examples. And so I thought it would be really cool today to actually talk through a deal that we're working on right now and be able to show you guys what it looks like when a multifamily deal comes together, talk about the reasons we like the deal, the things that we're looking for, talk about some of the risks. We've got Curtis to share even some questions from some of our really savvy investors that we can share and answer on here. And I thought it'd be a really cool idea to give you all just an opportunity to see a tangible deal, as it's going through the process. And so with that, we're going to dig in today. We're going to do kind of a mini episode and just really focus on our property, which we have under contract right now. It's called Maple Knoll Apartments. It's in Westfield, Indiana. It was built in 2008. It's really a B plus property. I think started as A, as it's aged a little bit, B plus. And our business plan is really about taking it back up to that next level. So first thing I really want to hit on, guys, is, what is it that we look for when we look to acquire a property, right? And in the 7 years Hudson Investing has existed, I mean, we've acquired all types of properties, whether it, workforce housing, C class to senior to B to A. And we've done new developments. We've done all different kinds of things. But right now, with where we are at the beginning of 2026, Maple Knoll is really just a great example of the type of asset we're looking for right now, based on our beliefs on where the market is, and where things are going. And what will give us really, as I talk about a lot on the show, right, that best risk-adjusted return, which is what we're looking for, right? We're looking to limit our risk and get the best return we can for each unit of risk. And so as we talk about Maple Knoll, we've got on the screen here, if you can see, or I'll just talk through it, like the 5 reasons why we really like this deal. And that really represents, again, where we think the most value is going to be in this timing of the market. The first one is Maple Knoll it's a large, what we would call an institutional class asset. What that institutional class means is, well, large institutions, REITs, and large investment firms are the ones that are typically buying and building these type of large scale 300 plus unit high quality properties, right? And that's exactly the case here. This property was originally built for GE Capital, and it's been owned by several large institutions along the way. And what's really cool is, for us, as we look at how these large institutions who kind of run these properties, more from a helicopter view versus someone like me who actually lives in Westfield about 7 minutes from the property, and just with more of our entrepreneurial tilt and our desire to really maximize the profit of the property, we see a lot of opportunity because of that. So we're excited kind of buying this large institutional asset, knowing that there's some meat on the bone and knowing that we can really go after it with our internal management team, and really, really, really dial down expenses and take advantage of what is a large rent gap in the market, where current rents are versus where new product is being delivered. There's about a $500 to $700 rent gap. So when you see that and know that we only want to raise rents about $140 to $250 to meet our business plan, we're not eating into that gap, right? We're only going about halfway there on some of the units. So we know there's still going to be a nice barrier between us and new product, which is extremely important. And one of the most important things we look for, and really where the analysis starts, is around the market, right? We talk about you've got to find a great market, and you got to judge the market before you judge the property, right? So Westfield, where I live, happens to be one of the fastest growing cities in the country. It's grown 34% in the last 5 years. And with that comes a lot of tailwinds, right? There's tremendous business growth, tremendous development, tremendous population growth. And it's really a situation we want to look for with real estate is like rising tides raise all ships, right? It's much easier to own a property in a market that's expanding and where jobs are coming in than in a market that's contracting. So, I mean, that checks that first box, right? In spades. And so Really it's recapping these things that are the reasons why we like this deal and thinking about the timing of the market. It's really a flight to quality from an asset standpoint, right? In a high growth market and making sure that there is room to move rents and so that you're not going to be right on top of where new product is being delivered. There's a nice gap there. And then really I think right now simplicity is important. I think as we've seen construction costs have increased. I think it's very easy for novices to overspend, and over improve, and do things that don't really drive value. And for us, this business plan is extremely simple. There are things that we know that we can change day one based on how we run the property versus how the previous owner ran the property, where we're going to create value immediately. And then we know that because we have our in-house management, we know that we are going to be able to run the property in a different way. And then when it comes to renovations, really it's a less is more approach. This property has been extremely well maintained and taken care of. They've already done a lot of partial renovations. So for us, we've identified with the current managers the biggest complaints that they get or biggest objections they get to leasing and renting. And those are the things we're going to target in on and like a surgical approach to fix within the units to give a better product, but maintain that rent gap, right? And so it's really this idea of what we're looking for right now. High growth markets. We're looking for high quality and larger assets because those are safer. It is a 300 unit is just, I mean, it's just going to be inherently safer than a 50 unit because of economies of scale and the ability to absorb, people moving out and things like that. And then making sure that you have a simple business plan that's easily executable and that there's many ways to win, right? There's many ways to be successful. And this one checks all the boxes for us. So, I mean, a lot of reasons we're excited about this deal for our first one in 2026.
Yeah, good, great recap, Kent. Do you want to switch over to some of the questions during the capital raise that have come up?
Yeah, I think now that people really understand what we're looking at here, I think that would be a really cool place to go on as people try to learn about investing in multifamily. We have investors that have invested in multiple deals, really smart individuals. And we've got some great questions, right? As we've been talking with investors about this. And so, yeah, I think it'd be great to run through some of those and let people just understand like how the smart investors are thinking about this and what kind of questions they're asking.
Yeah. All right, let's do it. So, one of the questions that I got that's really unique to this deal, right, is around our expense reduction assumptions. And so, in our business plan, we highlight an immediate $400,000 in NOI lift, right? Net operating income lift from insurance and expense savings. But the real crux of the question is how much of that is contractually locked versus market dependent, right? And I just thought, it's a great question. And I'll switch slides here as we get to kind of showing what happens to the cap rate as well.
Yeah, I mean, it is a really good question, right? Because that's one of the things that really excited us about this deal as we ran through the expenses line item by line item with the team, right? Was saying, okay, here's what they're paying now, but knowing what we pay on other properties and what we have contracts for, in our management platform, what will we pay? And what we saw was a meaningful decline, as you said, about $400,000 in expenses off the bat. So about 250,000 of that 400 is insurance. We have a master policy for our insurance across our portfolio, and our portfolio is largely Midwest based. So because of that, we're insulated from a lot of the natural disasters, right? We're insulated from the hurricanes and a lot of the big events that drive up premiums. And so our insurance prices are just lower. So our insurance prices are about half of what the current sellers insurance prices are. And that's about a $250,000 savings just by switching to our insurance, which we already have the policy. All we do is roll the property in. So that's really guaranteed. It's as much as guaranteed as you can get. I can actually say it's guaranteed. The other items, the other 150 are a mix of a lot of different contracts, whether it's software, whether it's IT systems, whether it's things like landscaping. because we have all these existing relationships on our management platform, local in Indy, and we just have superior pricing. And so
Yeah.
the vast majority of that 400,000 is kind of contractual, as you say,
Yeah.
versus us having to go and really operate differently, right? It's kind of same delivery, just better pricing in many ways.
Yeah, I love the way he phrased it, contractually locked, right? And so, yeah, most of that 400,000, is considered contractually locked. The reason it's a great question, right, from an educational side, is it separates underwritten certainty from best case operational wins, right? And so, as you go through a model or a deal, knowing that there's underwriting certainty or contractually locked on that 400,000 lift, that can give great confidence as you look at the day one cap rate of 5.14, where we
Yeah.
know there are similar comps in this particular market going at the 4.2 range, right?
Yeah, and as we thought about this deal, right? As we were evaluating this deal, I mean, there was a competitive process. There was a lot of very large institutions that wanted to own this property. I mean, 27 or so. And, I think one of the reasons that we ended up winning out for a couple of reasons. One is our local relationships, and the fact that we've just been, have great relationships with the brokers. And there's a lot of trust there because we've delivered in the past. Two, though, was us really seeing this shift immediately from an NOI of 2.6 to 3 million, which allowed us to, price it differently than some of the other competitors who are probably just assuming the same expense load because they just don't have that market experience.
Yeah.
So, I mean, that allowed us to be, you know, call it a little more aggressive on price, but know that we're gonna make that up immediately and end up with a 5+ cap deal really on day one,
Yeah.
which is a great cap rate for this type of high quality asset in Hamilton County,
Yeah.
Indiana, which just, I mean, requires a premium. All the properties in this county, because of the high growth, require a premium. So that was
Yeah.
really a crux of us getting comfortable with this deal and our underwriting and knowing that, we could make this a success.
All right. The next question is around competitive positioning long term. And I know we do such a great job during our acquisition process, and we have a lot of data points that come in to help point us in the right direction, right? And one of them is new supply and absorption rate. And so this question is sort of around that. And it goes with significant new Class A supply in Westfield and nearby submarkets. How does Maple Knoll defend its position as a renovated Class B plus asset over a 5-year hold period?
Yeah, I mean, that is a really good question, right? I think as we think about the risk side of things, I think one of the biggest risks to multifamily in general, just with how hot it's been in all markets, is supply risk, right? How much new supply is being delivered. And we've seen the impact of that. I mean, in the most extreme, in some of the southeastern markets like Austin, Atlanta, right? We've actually seen rents go negative. So part of the answer starts there with market. Even though there is new supply being delivered, it is not to the magnitude of what's happening in these, or what has happened in Austin, Phoenix, Atlanta, like these markets where people are flying in from all over the country to build there, right? Like the Midwest is insulated from a lot of that. And that's why the Midwest has really seen steady rent growth over a long period of time, because we don't have these big cyclical swings, right? So it's just the market is just better for steady growth because we don't see these massive ups and downs. So part of it starts with the market, and then it goes down to the property, right? Which is why we buy Midwestern properties, like, by the way. And then as you look at the property, a couple things stick out. This property was built in 2008. And when it was built, I mean, it was in the middle of a cornfield. Now it's in this high growth area where everybody wants to be, and everyone is developing, whether, it's a Meijer across the street, an Aldi across the street, a Wawa on the corner, right? All this. And what that's done is it's driven up land prices significantly. So this property is on 24 acres. It's a sprawling property. It's got every amenity you can imagine. It's got mature trees. It's just a really nice experience being on property. You can't do that with new construction because of just how expensive land is, right? I mean, land
Yeah.
has probably gone up X since this property was built. And so part of it is that. Part of it is just all of that drives the experience on site, but it also drives the price point, right? Because new product delivered in a tighter space with less amenities, but at a more expensive price, still has to charge more, and that's why we're seeing a $500 to $700 rent gap to new construction. And so, as we think about our rent increases, maximum being 250, we're still only halfway there, if not even to some of the newest, nicest. So we've got a better kind of feel on the property. We've got more amenities. This property has every amenity you can imagine, including we're going to build a pickleball court. It's a lower price point. We're going to renovate the units to have the same interior. I mean, it's going to look like a brand new unit on the inside, right? So same feel at a lower price point. And then also, I think location has a lot to do with it. So, really, this property is on kind of the southwest side of Westfield, really, closer to Carmel, which has been rated again this year one of the top places to live in the country, which has all the nightlife, all the entertainment, the walkable, everything that you want in a place to live, and that's why it's been voted one of the top places. Where the new products coming in is now having to be built 15 to 20 minutes north. So it's really just kind of a different area as well, and they're all kind of on top of each other there. So it's just there's multiple things tied up in there on why I think Maple Knoll, even with the largest glut of supply delivered last year in this county, about 2,500 units, Maple Knoll stayed 96% occupied. I think all those things have really driven that. I think in addition to having an award-winning management team, the property literally won Property of the Year in Indiana last year, and they've got a 4.6 Google rating, which for a lot of properties is unheard of. And so I think it's also reputation, and it's also the team on site, which is really a secret sauce. So I think all these things bring it together to, as we unpack this, we feel very comfortable about maintaining occupancy with our modest rent increases, even as new supply does get delivered over the next couple of years.
Yeah, you said it at the beginning. This property sits on 24 acres, and any new construction or competitor that's coming online in 26, 27, 28, the first thing that they're going to cut, right, is amenities, the walkability between units, and it's going to sit on far less acreage, right, to try to get the deal to work.
Yeah, it's really about buying less land, right? And cutting construction costs. And you do that, by kind of condensing things and then having less amenities.
Yeah, and why I think this is such a great question is that it really tests the durability beyond the initial value add phase. And I think just like you described, that's one of the reasons we love this property and why the risk is and the return, right? The spread on that is so great is because of that durability that's in place as a defense mechanism here.
Yeah, absolutely.
All
All
right,
right, what else? What's the next one?
let's switch to this one, right? So everybody always asks about the hold period, and we always explain to people on the second slide, it's a 5-year target hold. We do that just so that each of our, or plus value add deals are apples to apples comparison. But give me your thoughts on how long it's going to take us to execute the business plan. And then potentially what's happening with the new Fed chair and all this institutional money that's been on the sideline that has mandates and needs to come back in 26, 27, 28. So loaded question. Yeah, let's see where you go with this.
Yeah, there's a lot of things to unpack there. I think that at like the idea of kind of where are things going to go from here, right? And I think that what was remind me,
Well,
that was a big question. What was the first
yes.
part of it again?
Start with the business plan. I think it's unique when people hear a 5-year hold, they're surprised at how quickly we've executed the business plan.
Yeah, thank you. The business plan, the work for the business plan will be done in year one. And the way that we're able to achieve that is because, we've got a unique process for doing our renovations occupied, right? So our process is, and we've done this on several properties now, the resident leaves and gives us the keys about 8 a.m. And then we turn the property back over to them at 6 p.m., completely renovated. And, we're putting in new countertops, new light fixtures, new sinks and faucets with the countertops, new hardware in the apartment, on cabinets and doors and things, new flooring where it's needed. But a lot of the units in this property already have great LVP flooring. But because of that, it's going to allow us to completely renovate this property in 6 months, which would usually take about 3 years or even more here because the turnover on this property is only about 40% a year, which is about 10% better than market average. So with low turnover, it might take 3+ years to do that. So we're going to complete all that in 1 year, which then allows us, the way we do that, we don't raise rents right away because people have signed leases, and we're very upfront with people, but we tell them, hey, we're going to invest, $10,000 in your unit. The rents after that on your lease renewal will go up to this. And what we found is that people are largely accepting of that because, I mean, especially on this property, we're taking care of the biggest complaint, which is that there's a bar top counter. We got the sink here, this bar top here. It's only about 8 inches wide, so it's not really usable space. We're going to cut that down, put a nice big island on, and we're going to switch it from linoleum countertops to quartz. And so it's going to be a nice, beautiful quartz countertop. We just think what we've seen over and over again is that as people live in that nicer product, they learn to like it, and most of the people stay. And so on the lease renewal, then we're capturing all of those rent increases on the premiums from renovating in the first 2 years. So essentially, after the end of year two, we will have increased our NOI significantly. And then from there, it's really just about managing the property well and really looking at the market dynamics, which we were alluding to on the second half of your question, which is like, what's going to happen, right? Well, generally, the belief is that interest rates will continue to come down, especially as Trump puts his new Fed chair in place in May. Right now, the consensus kind of 2 more rate cuts this year. Who knows where that goes, but generally rates come down. As interest rates come down, that really opens things up for real estate, right? Every percentage point cut or quarter point cut makes the cost of capital less and allows people to more easily get debt, right? Which opens up the real estate markets. And then, as you said, related to, I mean, there's a lot of institutions with quote unquote dry powder sitting on the sidelines who haven't invested in several years as interest rates and inflation went up. And what we're seeing is those groups coming back into the market. Case in point, the 27 or so we were competing against on this deal. And so what we're going to do from years 3 to 5 is really run the property extremely well, watch the market and the market dynamics and timing. And when we believe that we can exit, and we can exit in a way that is going to outperform the return expectations that we've provided, then we're going to take the win, and we're going to sell the property and we're going to get all the investors paid out. It's really, while we underwrite it for 5 years, it's really that 3 to 5 year timing where we're watching and talking with brokers and getting opinions of value and understanding, the right time to exit the property and realize our gains.
Yeah, great stuff. I love that question because it really targets, okay, the potential for overachieving or upside as it's relating to a function of time, right? There's a lot of ways to overachieve on a property, and a lot of investors, the savvy ones, will ask questions around the likelihood and understanding the full business plan. And so I do think that's a unique trait, right, with the rapid renovations and the ability to execute the business plan on the early side and then leave yourself open in those final 2 years to pick and choose the best time to exit.
Yeah, absolutely. And so for everybody listening, I mean, this was a kind of a lightning fast version, just a little snippet, but just thought it would be cool to take a real life deal and give you the experience of what it's like to go through that and kind of how we think about those things. I think we covered a lot of cool stuff, right? From you need to be in a growing market. There's safety in scale, especially 300 plus units. You've got to watch new supply, and you've got to understand that you've got to have a nice cushion between what the new Class A stuff is being delivered and where your older property, even though it's extremely nice, is going to live, right? And it's great to have a simple business plan that doesn't require, for example, like gutting every unit and taking all this construction risk, And those are the things that we're really looking for right now in deals. That's why, I mean, we've been slow to move from deal to deal. We've evaluated a lot. This one really struck a chord for us and we went after it because we think it really checked all the boxes for us. And so, if you're like me, you like to hear those details. You like to hear the questions of what other people are asking, and it can spark things in yourself and kind of say, okay, here's how people are thinking about things. So I hope this is valuable for you guys. And with that, we'll sign off and hope you guys have a great rest of the day. I guess, well, with that, what I would add is if anybody's interested in learning more, you can go to HudsonInvesting.com/maple We'll put that in the show notes, and you can just access this presentation. You can check out our investor packet. No pressure. It's informational, but if you want to have a conversation with Curtis and myself, there's an opportunity to do that on the website and schedule a call as well. So just glad to provide this with you guys. And with that, we'll say, hope you have a great rest of the day.
Thanks for having me on, Kent.